Welcome to today's lesson. Today we are going to look at retirement of a partner. So retirement occurs when one of the partners leaves the firm and the remaining partners continue the business under a new agreement. When a partner retires, the following items need to be adjusted. The first thing is revaluation of assets and liabilities. So the firm revalues its assets and liabilities to determine the current worth. Any profit or loss on revaluation is shared among all partners, including the retiring one, in the old profit sharing ratio. So these are the journal entries for the revaluation. If there is a gain on revaluation, then we debit the asset account and then we credit revaluation account. So if the revaluation has happened on land, we are going to debit land account and then we credit revaluation account. The balance in revaluation account is transferred to the partner's capital account. So to do that, we are going to debit revaluation account and then we are going to credit the partner's capital account. So according to this point here, when we credit the partner's capital account, we are going to distribute that amount to all partners. It is going to be shared among all partners, including the retiring partner, and we are going to use the old profit sharing ratio. So that is because when our partner retires, the profit sharing ratio normally changes. So the remaining partner will have a new profit sharing ratio. But these entries here, we are going to record them using the old profit sharing ratio. So that is one adjustment that normally takes place whenever a partner retires. So let's see the next adjustment that usually takes place upon retirement of a partner, and that is goodwill. So this is how we treat goodwill on retirement of a partner. So first, goodwill represents the firm's reputation that has been created by the existing partners, that is including the partner who is going to retire. So it is only fair that the retiring partner is paid a share of the goodwill that he or she has helped to create. So the retiring partner is paid his or her share of goodwill. So for us to do that, these are the entries that we are supposed to make. A, we start by recognizing goodwill, and that is because most of the partners don't usually have a goodwill account. So if they value goodwill and previously they did not maintain a goodwill account, we have to start by recognizing that goodwill in the books. So to recognize goodwill, if there was no goodwill in the books, goodwill is recognized as follows. So we debit goodwill account and then we credit all partners' capital accounts in the old profit sharing ratio. We do this to all the partners. And then if goodwill is to be written off, then these are the entries we make, and we normally use the new profit sharing ratio. So we debit continuing partners capital accounts, and now we don't use the old ratio. Instead we use the new profit sharing ratio, and then we don't share to all the partners. Instead we share to the remaining partners only. And then after we debit the capital account, we credit the goodwill account. So that means if the goodwill is recognized and immediately after being recognized it is written off, we can skip the goodwill account. The reason is, in A we have debited goodwill, and then in B we have credited goodwill, and it is all by the same amount. So instead of debiting goodwill and crediting goodwill using the same amount, we can just debit the capital account and credit the capital account with the same amount and we skip the goodwill account. So the only difference is the way we share. When we are crediting, we share to all partners and we use the old ratio. But when we are debiting the capital account, we share to the remaining partners only and we use the new ratio. Yeah, so we can skip the goodwill account just by debiting the partner's capital account and crediting the partner's capital account. So those are the entries that we normally make when a partner retires. So another thing to keep in mind is that if there are any profits in the books of the partnership, the profit and any reserve that is in the books as at the time of retirement must be shared by all the partners before the partner retires. So these are items like general reserves, profit and loss balance, or undistributed profits or losses. They must be transferred to all partners' capital accounts in the old profit sharing ratio. So we debit general reserve account and then we credit the partner's capital account using the old profit sharing ratio. So we only do this if in the trial balance you notice there is an amount of profit that has not been distributed or an amount of general reserve that has not been distributed. So in summary, these are the procedures we follow whenever a partner retires. First, we prepare a profit and loss statement up to the time of retirement. That means you are going to share the profit to the partners. If there is any interest on capital, you are going to deduct it from that profit. In other words, you are going to prepare a profit appropriation statement. You deduct any salary paid to the partners, any interest on capital. Any profit that is remaining is going to be shared by the partners, and all those items will be transferred to the current account. And then number 2, transfer the current account balances to the capital account. So keep in mind that number 2 is going to be done only for the retiring partner. For the remaining partners, they will have a balance carried down in their current account. But for the retiring partner, you're not going to have a balance carried down. The balance carried down is for the remaining partners only. The one who is retiring, you're going to transfer their current account balance to the capital account. Then once you have done that, distribute revaluation and any other reserves to the partners, and then the balance carried down in the capital account for the retiring partner is paid in form of cash. If it is not paid in form of cash, it becomes a loan. So when you are preparing the statement of financial position, you are going to show it as a liability if it was not paid in cash. But if it is paid in cash, then you are going to credit the bank account of the partnership. So now we are going to do an example using one of the CPA past papers. So this question is obtained from the CASNEB past papers, that is CPA, and the exam sitting is December 2024. So if you have these past papers, you can look at December 2024 question 2. So let us go through the question. It says Anne, Ben, and Chad have been operating a partnership business under the name ABC Traders. Their partnership agreement provides for a profit or loss sharing ratio of 5:3:2 respectively. So now this is the old profit sharing ratio. Now we are going to see later what the new profit sharing ratio is. On that 1st December 2023, Anne retired from the partnership and left Ben and Chad to continue with the partnership, sharing profit or loss equally. The following balances were extracted from their books for the year ended 30th June 2024 before adjusting for Anne's retirement. So here you are provided with those balances. Some of them are assets, others are liabilities, income, and expenses. So let us go to additional information, starting with number 1. Number 1 says inventory was valued at 1620,000 and 1800,000 as at 1st July 2023 and 30th June 2024 respectively. So that means 1620 is going to be the opening inventory and 1800 is going to be the closing inventory, because 1st July 2023, that is the date for the year beginning, and 30th June 2024, that is the date for the year end. Number 2, as at 30th June 2024, rent and rates paid in advance amounted to 100,000. So we are going to deduct the prepayments from the expenses shown in the above balances. Number 3, as at 30th June 2024, general administrative expenses accruing amounted to 88,000. So we are going to be adding the accruals to the expenses shown in the balances above. Number 4, the partners made the following drawings during the year ended 30th June 2024. So we have the partner, we have the date when the drawings were made, and we have the amount. So it means that according to the dates we are given here, all these drawings were made in the current year. So we are going to adjust all of them in the current account. Number 5, depreciation is to be provided on a straight line basis as follows: building 2%, equipment 15%. Number 6, allowance for doubtful debt to be increased to 48,000. So increase in allowance for doubtful debt is to be treated as an expense in the profit or loss statement. Number 7, a balance due to Anne was to remain in partnership carrying no interest until 1st July 2024. So it means that when Anne retired, she was not paid in cash. Instead, the amount she was supposed to be paid was to become a loan. So we are going to classify it as a liability in the statement of financial position. Number 8, the value of partnership goodwill as at 31st December 2023 was agreed by the 3 partners at 4 million and was not to remain in the books of the partnership. So if it was not to remain in the books of the partnership, it means we are going to write it off. We recognize it first and then we write it off. Number 9, on that 1st December 2023, the partners agreed to revalue the land upwards to 3.2 million. So that gain, we are going to find the gain on revaluation and share it among the 3 partners in the old profit sharing ratio. Number 10, assume profits accrued evenly throughout the year. Required: A, statement of profit or loss and appropriation account for the year ended 30th June 2024, and B, statement of financial position as at 30th June 2024. So the first thing we are supposed to do is to check on the dates. So the dates are very important. We want to see the date when Anne retired so that we can count the number of months from the year beginning to the time of retirement, and then again we count the number of months from the time of retirement to the end of the financial year. So in the second paragraph, we are given the date when Anne retired. So you are told on that 1st December 2023, Anne retired from the partnership. So how many months from that 1st December 2023 to 30th June 2024, which is the date when the year ends? So because this is the end of the year 2023 when Anne retired, we are not counting the month of December. So we are going to start from 1st January 2024 all the way to 30th June 2024. So those will be 6 months. So since Anne retired, there were 6 months to the end of the financial year, which means there were 6 months since the beginning of the year to the time when Anne retired. So because Anne has retired in between the year, we are supposed to apportion income and expenses to 2 periods. The first period is before retirement, and the next period is after the retirement. And how do we apportion the income and expenses? In the additional information, number 10, it says, assume profits accrued evenly throughout the year, which means because she retired after half a year, half of the income and expenses will be allocated to the period before retirement, and half of income and expenses will be allocated to the period after the retirement. So there is the option of preparing the statement of profit or loss in 2 columns. We call it a columnar format. The first column being the period before retirement, the other column being the period after the retirement. But to make work easier, we can prepare in 1 column, and then we divide that profit when it comes to the appropriation of the profit, because according to number 10, it says assume profits accrued evenly throughout the year. So we can use 1 column until the part when we get the net profit. Then once we get the net profit, we divide it into 2. Half of it goes to the period before the retirement, the other half goes to the period after the retirement. So now we want to begin preparing the statement of profit or loss, and we are going to use 1 column first. So in the balances we are given, let us start by identifying the amount of sales. So the amount of sales is given here, that is 98.80. So 98.80, we are going to record it as the amount of sales, 98.80. From sales, we will go to cost of sales, and under the cost of sales, we want to start with the opening inventory. So opening inventory, we will go back to the question to find out what is the amount for opening inventory. So remember, in additional information number 1, we were given the amount for inventories. The first one, 1620, is the one that refers to the opening inventory. So opening inventory, we have 1620. From there, we are going to look for the amount of purchases, and we add it here. So in the balances we are given here, just above the sales, we have purchases, which is 58.20. So purchases, we have 58.20. From purchases, we are going to deduct the closing inventory. So in the question, let us check for the amount for closing inventory. Again, in additional information number 1, the closing inventory was 1800 or 1.8 million. So you have 1800. So we are going to do the workings to find the cost of sales. So to find the cost of sales, we are going to take opening inventory 1620 plus 5820 minus 1800 is equals to, so the cost of sales is going to be 5640. 5640. We are going to deduct 5640 from the figure of sales. 5640. So let us deduct 5640 so that we can get the gross profit. So 9880 is going to give us 4240. So 4240 is the gross profit. $42.40. So now from there we will go to expenses. So again we go back to the trial balance to find out what is the first expense that we have. So in the balances, we are going to start from the top and check for any expense that we come across. The first expense we have is staff salaries and wages, which is 1172. Salaries and wages 1172. So we have salaries and wages 1172. We check for the next expense that we have. We have rent and rates 500, but we have to check on the additional information for any adjustment to rent and rates. In number 2, we are told that rent and rates paid in advance amounted to 100. So we are going to deduct the 100 from the 500. So we have rent and rates 500, we deduct 100, so the net amount is 400. We go to the next expense, that is the general administrative expenses. So the general administrative expenses is 284. And then we go to the additional information number 3, where we have an accruing amount of general administrative expenses of 88. So 284, we are going to add 88. So general administrative expenses, we have 284. We are going to add 88. So let us do the additions. 284, we add 88, is giving us 372. So 372. We go to the next expense. We have bad debts written off. So bad debts written off, the amount is 18. So bad debts written off, we have 18. We go to the next expense. So if we go back, if we go at the top of these balances, we were given allowance for doubtful debts, and that is the allowance. If you check the date, it is on 1st July 2023, which means it is at the beginning of the year. and the amount is 42. So if we go to the additional information, number 6, allowance for doubtful debts to be increased to 48. So if there is an increase, it is only the amount of increase which becomes an expense, so not the whole figure. So we're going to take the 48, we deduct 42, which is the opening balance. So here we are going to say it is increase in allowance for doubtful debts. The closing figure is 48, the opening figure was 42, so the amount of increase is 6. So we go to the next expense. In the balances, we have exhausted all the expenses. And then in the additional information, we only have depreciation, which is given in number 5. So the first depreciation is on building, which is 2%, and it is provided on a straight line basis. So it means that we are going to multiply the 2% with the cost of the building. So let us now check the cost of the building. Building at cost is 6,400. So we take 2% of 6,400. So you have depreciation on building. It's going to be 2% multiplied by, let's confirm the amount again, 6,400 multiplied by 6,400. So that will give us 128. We go to the next depreciation for the next asset. So the next asset in the question is equipment. So equipment at cost is 960. Let us check the rate of depreciation for equipment in number 5. The rate of depreciation on equipment is 15%. So 15% of 960. So depreciation on equipment is going to be 15% multiplied by 960. So let us calculate that. 0.15 times 960. It gives us 144. So now let us check whether we have any expense remaining. So in the additional information, we don't have any other item that should be recorded in the profit or loss statement. So which means we are supposed to add the expenses, and then after we add the expenses, we get the net profit. So let us get the sum of the expenses. So the total expenses is 2240. So this total, we will transfer it to the same column as the gross profit, and we're going to put it in brackets so that we can deduct it. So 4240, which is the gross profit, minus 2240, this is going to give us 2000. So the 2000 is going to be the net profit. So now that we have the net profit, from here we are going to do the profit appropriation. And for us to do the profit appropriation, now we have to divide this profit into 2. So remember, there was a point that said in the additional informations, point number 10, assume profits accrued evenly throughout the year. So what we are going to do, we are going to apportion that profit into 2, So 2000, when you divide it by 2, it is going to give us 1000. So we are going to call the first period the period before retirement. And we are going to call the next period the period after retirement. And then the profit, we are going to divide it into 2 because both periods are 6 months. So 1000 will go to the period before retirement and 1000 will go to the period after the retirement. So what we are going to do now, we are going to perform the profit appropriation. We go back to the question. Identify any item that is supposed to be shown in the profit appropriation part. So normally, we deduct salaries paid to the partners. So in this question, I have not seen anywhere the partners are paid salaries. If there are no salaries, then we can look for interest on capital. And again, I have not seen anywhere interest on capital or interest on drawings. So it simply means that we are just going to share that profit among the partners. So in the first period, it is going to be shared to all the 3 partners in the old profit sharing ratio. So the 3 partners are Anne, Ben, and Chad. So those are the ones who are going to share the profit. The old profit sharing ratio is 5:3:2. So now let us share for the first half among the 3 of them using that ratio. So we have profit shared by, so the first partner is Anne and then Ben and then Chad. Profit shared by, first we have Anne, and then we are going to have Ben, and then we are going to have Chad. So Anne is going to take 5/10 multiplied by the profit, which is 1000. That is half of 1000. So Anne is going to take 500, which you are going to deduct. And then Ben is going to take 3/10 multiplied by 1000. That is 300. And then Chad is going to take 2/10 multiplied by 1000. That is going to give us 200. And then we have completed sharing for the first half of the year. Then let us look at the ratio for the second half of the year. So on this paragraph, the second paragraph, it says that on that 1st December 2023, Anne retired from the partnership and left Ben and Chad to continue with the partnership, sharing profit or loss equally. So after Anne retired, the new profit sharing ratio is equally. That means 1:1. So after Anne retired, she is not going to have any share in the profit. Ben is going to take half of the profit, and Chad is also going to take half of the profit. So in the end, after they have shared, no profit will be remaining in the income statement. So that is the end of the first part, the profit or loss and appropriation statement. So now we are ready to go to the next part, which is the partner's current account followed by the partner's capital account. In the question, the required part of the question, they had not asked you to prepare the current account and the capital account. You are just required to have the statement of profit or loss and statement of financial position, but you are supposed to prepare the current account and the capital account as part of your workings, even if the question does not require you to prepare those ones. So they are very important because you will need to find the balances to use in the statement of financial position. So to start with the current account, let us look for the opening balances for the current account. So these are the opening balances in the current account. So notice that some of them are credit and one of them is debit. So the one that is debit means that it should be recorded on the debit side of the current account. So we start with the first one, that is earn. The amount is 60 and it is credit. So that will be the balance brought down. That will be the balance brought down. So earn is credit balance of 60. Then the balance is on the opposite side. Balance brought down. So let us look at the balances for the other ones. So for Ben, the balance is 40 and it is on the debit side. For Chad, the balance is 40 and it is on the credit side. So for Chad, we have 40. That is Ben. So for Ben, we have 40 on the debit side. For Chad, we have 40 on the credit side. So once we have recorded the balances, let us now record the profit share as we have calculated above in the appropriation section. So we have the profit share. So profit share, we are going to be adding for the 2 periods. And he shared for 1 period only, which was 500. So for Anne, we will have 500. For Ben, the share for Ben is 300 for the first period and 500 for the second period. So the total is 800. So the share for Ben is 800. The share for Chad, the first period was 200, the second period was 500. So when you add the two, the total amount is 700. So from there are other items that must be recorded in the current account, and those include the drawings, and even the goodwill can also be recorded here, especially if the capital amounts are not supposed to be adjusted. So first, let us bring the drawings which we were given in the additional information. So in the additional information number 4, you were told that the partners made the following drawings during the year. So Anne, the drawings for Anne, we have 420. So first we record that the drawings for Anne, we have 420. Then we check for Ben. The drawings for Ben is 740. 740, and for Chad is 720. So we record the two of them, 740 and 720. So once we have recorded the drawings, the next thing, let us now look for anything else that is supposed to come to this account. So remember in the question, we had goodwill and we had revaluation. So in number 9, the partners agreed to revalue the land upwards to 3.2 million. In number 8, the value of the partnership goodwill was agreed by the three partners at 4 million and was not to remain in the books. So let us remind ourselves how we are supposed to record the revaluation when a partner retires. We said that if there is a gain on revaluation, we debit asset account, we credit revaluation account, we debit revaluation account, and then we credit the partner's capital account. So we are going to skip the revaluation account because it is going to cancel out. We credit and we debit with the same amount. So ignore the revaluation account. So if we ignore the revaluation account, we are going to debit the asset account and then we credit the partner's capital account. And then for the other one, that is the goodwill. To recognize goodwill, we are going to debit goodwill account, credit partner's capital account. To write off the goodwill, we are going to debit partner's capital account, and that will be the new ratio, and then we credit the goodwill account. So the entries number A and B are sufficient for the accounting for goodwill. So now let us first calculate the closing balances of the current account so that we can proceed with the capital account. So the balance carried down, so this will be 560 minus 420, 560 minus 420, that is 140. For Anne, it is going to be 140. For Ben, it is going to be 800 minus 780, that is going to be 20. For Chad, it is going to be 740 minus 720, that is going to be 20. So just one thing you're supposed to remember here, a retiring partner does not usually have a balance carried down because this amount is supposed to be paid off. So instead of calling it balance carried down and the partner is retiring, that balance will be transferred to the capital account for it to be added with the capital amount so that it can be paid off. So only the remaining partners are going to be having a balance carried down. The retiring partner will not have any balance carried down. So in the current account, that is all. The only thing you can do is to add the totals, is to get the totals. So let us proceed with the partner's capital account. So in the partner's capital account, let us start with the balances, the opening balances, the balance brought down. So going back to the question, we want to find the opening balances in the balances given here. The capital account balances are given here and they are all credit. And Ben, Chad, we have 36, 34, and 32. We have 36, 34, and 32. Those are the opening balances. And then for the retiring partner, who is Anne, we are going to bring the balance from the current account to this account. So this balance here that we have called the capital account 140, that is the one you are transferring from the current account to the capital account. That is 140. So from there, let us record the revaluation gain. So revaluation gain is normally credited in the capital account. Revaluation gain. We are going to use the old profit sharing ratio. So first, how much is the revaluation gain? Let us go to the point number 9, where we are told the partners agreed to revalue the land upwards to 3.2 million. So this is the new value of land. So what was the previous value of land? We go to the balances above. The previous value of land at cost was 2.4 million. So which means that the gain is going to be that 200 minus 2400. So the gain is going to be 800. So this 800 is going to be shared by the partners using the old profit sharing ratio 5:3:2. So let us share that. So Anne is going to get 5/10 you multiply by 800. So Anne is going to get 400. And then Ben is going to get 3 divided by 10 you multiply by 800, 240. So Ben is going to get 240. And then Chad is going to get 2 divided by 10 multiplied by 800, 160. So Chad is going to get 160. From there, we want to record the goodwill. We want to recognize goodwill on retirement. So what is the amount of goodwill? Let us confirm the amount of goodwill in the additional information. Number 8, goodwill is going to be 4 million according to point number 8. So the goodwill, once we recognize the goodwill, we normally use the old profit sharing ratio. So Anne is going to get 5/10. So 5/10 is half, and that is 2 million. Ben is going to get 3 divided by 10 multiplied by 4 million. That is 1200. And then Chad is going to get 2 divided by 10 multiplied by 4 million. Chad is going to get 800. So that is goodwill recognized. On the other side, we are going to have goodwill written off. Remember, the retiring partner is not going to have any share. So Anne is not going to have any share. And then Ben, remember the new profit sharing ratio. After Anne retired, they agreed to be sharing profits equally. So that means the goodwill will be written off equally among the two, between the two remaining partners. So Ben will take 2,000, Chad will take 2,000. So from there we can calculate the balance brought down. Let us first find the totals on the credit side. So for Anne, we have the total 6140. So for Ben, the total is going to be 3,400 plus 240 plus 1,200. That is 4840. 4840. And then for Chad, the total is going to be 3,200 plus 160 plus 800. The total is going to be 4160. 4160. So now the balance for Anne, since Anne doesn't have anything on the debit side, the balance for Anne will remain the same. So the totals on the credit side are going to be the same as the totals on the debit side. So the balance for Anne is going to remain the same, that is 6140. The balance for Ben is going to be the total 4840 minus 2,000, that is 2840. The balance for Chad is going to be the total 4160 minus 2000, that is 2160. So those are the balances for the partners. These are the totals for both sides. So we are done with the partners capital account. So next we go to the statement of financial position, and we are going to start with the non-current assets. So the non-current assets, we had land, and remember after evaluation the new value of land became 3.2 million. And then we have building. So building, let us look at the cost of the building in the question. Building at cost is 6,400, and there is accumulated depreciation of building which is 490. So we are going to take 6,400, we subtract 490. So 6,400 subtract 490. That is 480. So 6,400 subtract 480, and then we also subtract depreciation for the current year for building. We go back to the profit or loss statement. The depreciation amount for building was 128 for the current year. So again we are going to deduct here 128. So the net book value of the building is going to be 6,400 minus 480 minus 128. It is going to be 5792. 5792. The next asset is equipment. So let us confirm the cost of equipment in the question. Equipment at cost is 960. Accumulated depreciation on equipment is 220. So you are going to take 960 minus 220. So 960 minus 220. And then again we deduct depreciation in the current year, which you are going to check in the income statement. Depreciation on equipment from the income statement was 144. So we deduct 144. So the net book value for equipment will be 960 minus 220 minus 144. It gives us 596. So 596. So that is all for non-current assets. So the total for non-current assets is going to be 9588. Let us now proceed to current assets. So let us now look at the first current asset in the balances in the question. The first current asset we have is trade receivables. The amount is 1368. And remember, there is going to be an adjustment for trade receivables because of the allowance for doubtful debts. So first, we are going to take this amount, 1368 of trade receivables, 1368. We are going to deduct the allowance for doubtful debts. Remember, we had this allowance here, 42, but because this is at the beginning of the year, we are not supposed to deduct that. Instead, we deduct the balance at the end of the year, which is given in number 6, 48,000. So here we are deducting the whole amount. Remember, in the income statement, we only included the increase only, but here we deduct the whole amount. So the new value will be 1368 minus 48. So that is 1320. We go to the next current asset. We go to the balances and look for the next current asset we have. We have cash at bank. Cash at bank is 84. So let us record that. Cash at bank 84. Remember, we also have inventory, the closing inventory. Closing inventory was given in number 1, 1800. So closing inventory 1800. So I think the only remaining current asset we have is number 2, rent and rates paid in advance amounted to 100. So that is called a prepayment, and it is also a current asset. So you have prepayment of 100. So I don't think we have any other current asset. So if we have exhausted the current assets, before we proceed to the financed by section, let us add the assets. Let us add the assets. The total for current assets is 3304. We are going to bring that total to the same line with the total for non-current assets. So we want to add the two figures. Non-current assets total is 9588. So let us combine that to the total for the current assets. So 9588, we add 3304. It gives us 12892. 12892. 12892. Yeah, so from there, let us go to financed by. Financed by. We start with capital accounts. So we are going to show capital accounts for each partner. So if a partner has retired, then they don't have any more capital here. So it is going to be only for the remaining partners. Who are the remaining partners? The remaining partners are Ben and Chad. And their capital balances, we have them here. So Ben and Chad. So you're going to have Ben. And then again, we are going to have Chad. Similarly, we are going to the current account and show only the two partners that are remaining. That is Ben and Chad. So the balance in the capital account for Ben is 2840. For Ben, 2840. For Chad, in the capital account is 2160. So something else I have noticed is that for Anne, we are not supposed to have a balance brought down because the partner has retired. Instead, we are going to call it a loan, not a balance. In fact, that should have been a balance carried down. It is not a balance carried down. Instead, it is going to be loan. It is going to be loan because the partner is supposed to be paid in cash. If she is not paid in cash, the amount becomes a loan. So she doesn't have a balance carried down. So for Chad, we have 2160 as the balance for capital. And then for the current accounts, let us check the balance for Ben. In the current account, both Ben and Chad have 20 as the balance carried down. So you're going to show there 20 for both of them. So first, let us sum them up, the financed by items. And the sum is 50/40. We proceed to current liabilities. Under the current liabilities, let us start with the loan from Anne, because if that loan is going to be paid within less than a year, then it is supposed to be classified as a current liability instead of an uncurrent liability. So loan from Anne is going to be the balance that we have in the capital account for Anne, the one we have named here loan, 6140. So we're going to show there 6140. That is the amount Anne should be paid by the partnership business. Apart from that, we go back to the question to find other liabilities. We had trade payables 1624. Trade payables 1624. So we have other current liabilities. Apart from those ones, in the additional information number 3, we had accrued general administrative expenses that were amounting to 88,000. So accrued expenses are also liabilities. So they're going to call them accruals. 88. So from there, I think we don't have any other current liabilities. So the total for current liabilities is going to be 7852. So this total, we're going to put it in the same line as the total for the financed by items. So let us sum them up, see what we get. So 50/40 plus 78/52 is giving us 12,892. 12,892. So the total for capital and liabilities is the same as the total for all the assets, current and non-current. So we had 12,892 for the assets, and we have 12,892 for the capital and liabilities. So that is the statement of financial position of the partnership after the retirement of a partner. And that is the end of this video. So from here, you can try to do one of the questions on your own. We have an example here. We have a question here from one of the past papers. It's also a retirement of a partner question. You can try and see if you can be able to solve this question. In this question, in additional information number 1, you are told that John retired from the partnership from that date Abel and Raymond were to share profits and losses equally. So if you need this question, you can download it in the link that you will find in the first comment of this video. It is also available in the CASNEB CPA past papers, but I did not indicate the year. So you can just download it and attempt to solve it. So that is the end of the lesson. Thank you for watching. See you in the next lesson.